For small to medium-sized companies, it may seem like work comp companies are trying to just gouge you for as much money as they can get. And well, they are. Nah, just kidding. It really comes down to some simple math using payroll and rate. So let's take a look at the math and see how work comp policies are priced. We first start with class codes. Every industry has its own unique set of class codes that are defined by the Department of Insurance and the WCIRB. So for restaurants, 9079 is the primary class code that is assigned to that industry. Once we know our class codes, we can then take a look at the base rates that the insurance companies use for that particular class code. For each class code, the insurance companies report the total amount of loss that was incurred for every company in the state of California. That loss information is put together in a report that insurance companies use to understand what the expected loss is per $100 of payroll for each industry that they underwrite. The insurance companies take that loss data and they add their overhead and expense to it to create a base rate by industry or class code. All right, step one, using class code 9079 for restaurants, we are going to take our estimated annual payroll of $500,000 for that class and divide it by 100 and then multiply it against the base rate that the insurer is using, which in this example will be $4.50, 4.50, to come up with an initial premium of $22,500. Before we go to the next step, we're going to explain what an experience modification is. This is a factor that is used to compare your loss experience to that of everyone else that's in your industry and class code. The median value for an X mod is a 1.0, which would effectively just leave your rates the same. However, if your experience is better than the rest of the industry, your modification factor will be less than 1.0, or it will modify your rates and your premium downward. If your losses are worse than the rest of the industry, then your experience modification will be greater than 1.0, which will create a debit or a surcharge against that of your rate and your premium. So for this example, we'll take $22,500 and multiply it by 0.75 or 75% to come up with a modified premium of $16,875. All right, for step three, insurance companies may file to apply discounts or surcharges for a variety of other reasons, such as your premium size, or your safety programs, or your owner involvement. Those factors we are going to just summarize in one modifier here. So we will take our new premium of $16,875 and we're going to apply a discount for this example of 0.9 or 90%, and that will give us a new modified premium of $15,188. That summarizes the steps to get to your final premium of $15,188 as an insurance company may underwrite a policy. There is, however, another way to get there, and so what we can do is look at taking the base rate of 4.50 and then applying the experience modification of 0.75, and then also modifying that with a 0.90 multiplier. If we combine all those rates by multiplication, that gives us a final net rate of 3.04. Once we know our net rate, we can go back to our payroll amount of $500,000 and again divide it by 100 and then multiply it by the net rate of 3.04. This will also give us a final premium calculation of $15,188. And that's your quick and easy summary of how work comp policies are priced. Be on the lookout for more C3 Academy videos where we take complex insurance topics and we break them down into terms that normal business people can understand.